In this video, I'll be reviewing the Grinold-Kroner model that is used to estimate the return of equity markets. Now, in the CFA Level 3 syllabus, this comes under the readings on capital market expectations. So it's pretty much the same model as the last few years, but there are some new subcomponents and also a different way of calculating when we are assuming a long-run horizon. So let's review through the model. So first, we have the expected return on equity. Okay, and then this is approximately equals to D over P, which is the dividend over price, and this is the dividend yield of the equity market, plus the expected nominal earnings growth return, and then we minus the percentage change in shares outstanding, and then lastly, we plus the expected repricing return, or the percentage change in price to earnings ratio of the equity market. Now we look at the subcomponents. So first, if you look at the bracket, okay, we have this bracket here represents the growth rate of earnings per share. For example, if the expected percentage change in shares outstanding is negative 3%, that means there is a net share repurchase of 3% of the shares, which is a decline in the percentage change in shares outstanding. So a negative figure also represents or implies that the EPS grows faster than total earnings. Now, if you were to take the dividend yield minus the percentage change in shares outstanding, that would give us the expected cash flow return or income return. And the percentage change in the price to earnings ratio plus the expected change in nominal earnings growth return is what we call the expected capital gains. Now let's look at an example. We have John Tell that uses the Grinold-Kroner model in forecasting developed market equity returns. So Tell makes the following forecasts. So there is a 2.4% dividend yield on US equities, a 1.5% rate of net share repurchases for US equities, a long-term corporate earnings growth rate of 5% per year, an expected US nominal GDP growth rate of 4%, an expansion rate of for PE multiples of 0.6% per year. So calculate the expected return on US equities. So based on the model, so the dividend yield is 2.4%. Then we add in the expected corporate earnings growth return or rate of 5% per year. Then we minus the net share repurchase, which is a negative number. So this will be bracket negative 1.5%. Okay, and then we add in the expansion of the P multiple of 0.6% per year. Now, adding this up, we would have expected return of 9.5% for US equities. Now, what if you are asked to calculate the expected cash flow or income return on US equities? So that will be the dividend yield minus the percentage change in shares outstanding. So calculating this number, this will be 2.4%. Okay, minus negative 1.5%. So this will be 3.9% expected cash flow return or income return. Then for expected capital gains on US equities, we'll take the percentage change in corporate earnings and then we'll add to the percentage change in the PE multiple. So we'll take percentage change in corporate earnings and then plus percentage change in the PE multiple. So this will be 5% plus 0.6%. So that's 5.6%. Now, if you're asked to calculate the growth rate of earnings per share, that would be the term in this bracket. So we'll take the percentage change in earnings, okay, minus percentage change in number of shares outstanding. And then this will be 5% minus negative 1.5%. So that's 6.5%. Now, lastly, if you're asked to calculate the expected return on US equities in the long run, so take note that in the long run, we assume that the percentage change in shares outstanding will approach 0 and there will be no change in the PE multiple. So and the percentage change in corporate earnings growth rate should approximate the nominal growth rate, nominal GDP growth rate of the economy, which in this case is 4%. So in other words, this will be approximately equals to D over P plus the nominal GDP growth rate for the economy. So that will be 2.4% plus 4%. So that will give us a 6.4% expected return on the US equities in the long run.